Hi, this is David Roach, Independent Strategy and Quantum Economics. Welcome. We're going to talk again about China, which we last did on my birthday, July the 5th. What we're going to talk about is the change in regulation of corporations in China and how it affects foreign investors. I will cut to the quick and go to the bottom and tell you straight away that there are two results, implications for a foreign investor. The first is that the risk has gone up. And with it, of course, things like the discount factor for future equity earnings, which now should have a much higher discount factor. And similar, there is a prudence and prudential issue as to whether certain institutions, such as state pension funds or teachers' pension funds, which are paid to be prudent and cautious, should be invested in China in the first place. And that extends not only to equities, it extends to all forms of investment. And what I'm not saying is that one shouldn't invest. I'm saying the motto here is eyes wide open. Now, what has actually happened? If you go back to the beginning of the year, a very important principle was implemented. It basically was to establish the absolute superiority and hegemony of the Chinese Communist Party over all forms of corporate and entrepreneurial activity. The incident was the famous Ant listing and Jackie Ma declarations that Chinese banks were like pawn shops because the digital banks, which he was running, were a lot better. They were also unregulated and a threat to the system, which was a genuine complaint by the Chinese authorities. So what happened was that the Ant listing was cancelled, and bar a few very muted murmurings, Jackie Ma hasn't been heard of since, and he certainly hasn't been criticizing state-owned banks. So this was an important thing because what it showed was that irrespective of timing, a few days before the listing, irrespective of the corporation, Alibaba and Ant, both of them intertwined, being a flagship Chinese company, the priority in China is always, and even more so under the current President Xi and his regime, the priority is always the Chinese Communist Party, its preeminence, not only in political terms, where it brooks no rivalry or multi-party system worthy of the name, but in all spheres of life, be it private life or be it economic life. The second thing that happened came just around July the 4th, which is that a ride-sharing company called Didi and two other transport sharing companies, basically for trucks, plus a temporary employment agency, were put in the crosshairs of Chinese regulation. Didi, which had just done a $4 billion listing in the New York Stock Exchange, saw its share price collapse when the listing was declared to be against Chinese interests, national, and against regulation on the keeping of data. The same applied to the other three companies. Now, the interesting thing about this is, in the first instance, the Ant, Jackie Ma, Alibaba affair, the threatening rivalry to the Chinese Communist Party was seen to be wealth, personal wealth. And the party recognized that if enough personal wealth was accumulated by individuals, they would become a rival source of power to that of the Chinese Communist Party. So that's why that happened, at least from a political point of view. In the second instance, which is the ride-hailing companies and the Temporary Employment Bureau, it's quite different. What is being combated here by the regulator, stroke the Chinese Communist Party, is the accumulation of data in private hands. And furthermore, the risks that that data would become accessible to foreign players, foreign powers like the United States, if these companies list abroad. Now, you know and I know that the Chinese Communist Party, which is indistinguishable from the state, accumulates vast amounts of data on everybody, weeds out dissidents, and controls people. So it is not the gathering of data on individuals which really upset the party. It is the gathering of data by non-party entities, private sector companies, which seriously upset the party because they saw, the party saw, that that was actually a more lethal form of power in private hands to the accumulation of wealth. And therefore they stamped down on it. And since then, of course, what has happened is that the private sector educators, which also accumulate data, but are deemed to work the little kiddies too hard in their private tutorials of the weekend, and so on, thus stopping people having children because it's so expensive to have one and pay for all this kind of tutorials and teaching, private sector teaching, online teaching. The party has now clamped down on that, which, of course, affects some very big stocks, like Tencent. And these stocks have fallen, but not quite as much as some of the education stocks, which are down by over 90% since the beginning of the year. Now, you can make an argument, and in fact, I read a paper yesterday from a large US bank, which clearly has given instructions to its analysts not to criticize in any way China and not to bring up the political dimension of regulation of private sector corporations and individuals, which I've been talking about. And they published a lengthy article yesterday which went into the need for increased regulation in China without ever mentioning anything I've just mentioned. Now, that, in my view, is simply corruption of the independence of analysts by companies which are more interested in doing business in China than they are in pointing out to investors what the risks are of doing business in China. But we won't dwell on that. What I will say is there is an argument for increased regulation in China. In a sense, if you look at the Googles and the Facebooks and the Twitters and the Instagrams of this world, in the West or in democratic Eastern countries, people have a lot of gripes about the dominant market position of these corporations who just spin out more money for their owners during the pandemic when things were tough, but they just get richer, whose dominant market positions enable them to price in ways which are denied to any sector which has got an advanced degree of competition. And there is, as you can see from the examinations going on in Europe, challenging a number of these corporations, and in the United States, challenging their monopoly positions, there is a very strong tide in other countries outside China to regulate this sort of company. to make it more accountable, to make it more democratic, to be responsible for its content, and to compete so that its pricing power is not that of a monopoly. You can take that example and you can apply it to China. And actually, the situation in China is, if anything, worse, because the Alibabas and Tencents and so on of this world are, in proportion to the size of the market, even bigger and more dominant. In fact, one of the prominent online retailers accounts for approximately 80% of the transactions in the entire 1.4 billion people Chinese retail market. So there is a regulatory argument which China is quite entitled to make and to pursue in the way that it chooses to actually regulate those sort of stocks. But I'll leave you with this thought. Behind that form of regulation lies another. It is the regulation and the control of power by any Leninist party. Let me say straight away, I'm not talking about Marxist-Leninist parties, which nationalize the means of production and are egalitarian in terms of splitting up the economic cake. That is not what we're talking about, because China has the worst Gini coefficients of wealth and income distribution of practically any country, except perhaps Brazil, among the developing world. So we're not talking about that sort of Marxist-Leninist thing. We're talking about a Leninism. And Leninism is basically a creed which is centered upon the absolute control of the party and the subjugation of the people. And that is the form of organization which China has, and which, as far as I can see, the Chinese people, being blessed with continued increases in living standard, albeit at declining rates of increase, they're happy with that, or at least they're not revolting against that, even if they could. So that is what China is doing. And what we are seeing is the assertion of the absolute dominance of the party, the Chinese Communist Party, which is at the center of the Leninist structure of the state and party in China. What you can never do is say that does not affect investments. Because, to take the most simple example, you can do your work on a corporation and work out what the future profits are. You can take the interest rates of China and add a risk premium and discount it back and get a present value for the shares. And you can turn out to be 100% right in your predictions of the fundamental workings of that stock. But you can turn out to be 100% wrong as regards the value of that stock or what it means for the money you manage. Because the political risk is divorced from the economic assessment of the corporation, and the political risk can come into play at any time without any warning, and is a layer of risk which can affect value enormously. That is what you have to be aware of, as I said in the beginning, eyes wide open when you invest in China, which is not to say you shouldn't invest in China, but you should know what you are doing.